central banks bought 37 million ounces of gold, a multi-decade record. Over the last 18 months, they bought more than at any time in history. And, so if you talk about this here, you're right. They bought 800 tons so far in the first 9 months of the year. That's up 14% year over year. Last year being the biggest year on record, and now it's up another 14%. And I think, in short, we're on the verge of this shift from in international finance, and gold is going to replace the Treasuries, I think, as the premier store of value, and it is happening.
In a world characterized by escalating conflicts and evolving geopolitical alliances, financial experts like AndySchectman from Miles Franklin Precious Metals observe a shift away from the dollar and a growing inclination towards precious metals. According to Schectman, smart money is swiftly accumulating gold and silver, a trend he anticipates will gain momentum in the coming months. Estimates from the World Gold Council, scrutinized by Bullion Vault, indicate a remarkable surge in central bank gold buying, surpassing half in weight over the past 3 years compared to the preceding 12 calendar quarters. Schectman contends that central banks are discreetly capitalizing on the suppression of the Western paper market to accumulate gold, a strategy he believes is gaining traction. The latest reports on the substantial drop in LBMA gold and silver inventories shed light on intriguing developments. The decline in gold holdings is attributed to central bank purchases and a notable shift towards taking physical delivery. Meanwhile, the surge in silver demand during India's Diwali festival is a primary factor contributing to the decline in silver inventories. From Arcadia Economics, Chris Marcus notes a surprising twist in the LBMA silver vault holdings, where levels had stabilized earlier in the year before, witnessing significant drops in October. One key concern Schectman highlights is the staggering 1,700% difference between paper contracts and physical silver bars in the market. This problematic practice prompts questions about market integrity and the potential for a disconnection between paper and physical assets, posing challenges to the transparency and reliability of these markets. Join us as we delve into insights shared by AndySchectman. To stay updated with our latest uploads, be sure to subscribe to our channel and activate notifications. Thank you.
These central banks not only have been voraciously accumulating it while using the suppression of the Western paper market to run cover, where you have 35 times leverage and you can short the market on paper and buy the physical without really the whole world jumping into it because of the price going to the moon and attracting attention. In fact, quite to the opposite. The counterintuitive price action and the suppression of the market has enabled these big players to front run what is ultimately going to happen. And I don't think we've begun to really see anything yet as far as that is concerned. These traders are always way, way, way ahead of the curve. And when it breaks when there just isn't any ability for the Western suppressed markets to suppress in a naked fashion. In other words, it will be far too dangerous to sell short. Let me say what I mean by naked. Right now in silver, as an example, there is 1,700% more paper contracts than there are bars backing those contracts. In other words, it's rehypothecated 17 times. And so if for every one real contract that could be delivered in physical form, 16 won't be, or 17 won't be. You get paper settled. It is rehypothecated. And that's why we're already beginning to see in China, as an example, the Shanghai Gold Exchange has gold price, last I looked, at about $100 higher than the LBMA or the COMEX price. I don't care what these economists tell you is the justification. In my mind, they are trying to arbitrage slowly whatever is not nailed down. And they've already done a good job at pulling stuff out of the COMEX, out of the LBMA. They're pulling the physical commodities, not just gold and silver. You're seeing the industrial metals too, aluminum and zinc and copper. They're all being accumulated by these nations, and they're using the suppression of the Western markets to do it. At the same time, they're selling treasuries. So if anyone wonders why the treasury market experienced its worst year ever and the yields keep rising and the back end of the curve keeps rising, because they're all dumping their long treasuries. And even at a loss, I think they would rather sell them and shift and transition to gold before things get really dirty. So yes, I think that what we will ultimately witness is a moment in time where the rehypothecated levered Western paper markets will enable the rest of the world to siphon everything out of the weak hands of the West, and it will all move eastward. And when all of the metal is there, or the majority of it, where the Western markets are rendered neutered or a scam because of their hypothecated model, then you will see other parts of the world establish a more reliable and credible benchmark, whether it be in Abu Dhabi or the Shanghai Gold Exchange or the Moscow Metals Exchange. It will be that portion of the world, those who have been accumulating it all, who produce it all, who understand what it really means. They're going to say, we don't want to buy from your Western system anymore, and we don't believe in your Western system anymore. And in fact, we are going to implement our own system. And, you can see how banks will arbitrage for a few cents a share, millions and millions and millions of dollars. Well, how about $100 an ounce? How about putting silver at $50 and watch what happens to all the silver over here that immediately arbitrages over there in a one-time shot to make these bankers very wealthy. And now we have stripped clean all of the physical silver and gold that will be available that would have been available for the people in this country who will wake up last minute and say, whoa, geez, I better get something. And it will define this market, the inability to source product on every level. And that's when the price goes parabolic.
The recent decline in Treasury bond prices, propelling longer-term borrowing costs higher, has led to a significant milestone in the annualized interest payments on the U.S. government's outstanding debts. Bloomberg's analysis reveals that these interest payments surpassed $1 trillion at the end of last month, doubling this figure over the past 19 months. Strikingly, this amount now accounts for 15.9% of the entire federal budget for fiscal year 2022. Simultaneously, China's robust gold buying activity contributes to a broader trend of increased purchases by global central banks, providing substantial support to bullion prices. This development, highlighted in a separate Bloomberg report, indicates a shifting dynamic in the global financial landscape. According to industry expert Andy, the trajectory suggests a notable transformation in the perception of gold as a preferred store of value on a global scale, potentially replacing treasuries. Let's get back to the interview.
I think that's why they've used the Western suppression to run cover for their accumulation, which I would argue has been going on at least since 2017 or 18, when you saw the repatriation by the central banks from the New York Fed and the Bank of England, starting with the Bundesbank. And in 2018, all of a sudden, those banks bought more gold that year than they did in the 60 years previously combined. That would be like the Dutch National Bank, the Bank of Hungary, Turkey, the Czech National Bank. All of these countries have been on a buying spree, many, many others on a buying spree, of course, China and India and all of those. But look, let's just, again, like I said earlier, from a historical point of view, using government treasuries and bonds as a savings vehicle is a relatively new concept in the historical context. And I think it's fading. And I think that already the elite have rediscovered gold is and has always been the premier store of value. And I think it's happening in a big way. And as you mentioned, last year, the central banks bought 37 million ounces of gold, a multi-decade record. Over the last 18 months, they bought more than in any time in history. And, so if you talk about this here, you're right. They bought 800 tons so far in the first 9 months of the year. That's up 14% year over year. Last year being the biggest year on record, and now it's up another 14%. And I think, in short, we're on the verge of this shift in international finance, and gold is going to replace the treasuries, I think, as the premier store of value. And it is happening. More so in silver than in gold. At least gold is close to its all-time high, 10% or so. Silver's under half of its all-time high. And that has killed all incentive over the last several years for exploration. And I don't know what the lag time is from exploration to discovery to production, but I would assume it's quite lengthy. And so this is already happening. It will only accelerate as the cost inputs go higher. And so it's a situation where in silver in particular, like if you look at all the silver that was mined last year, somewhere in the neighborhood of 1 billion ounces, roughly, only 350 million, or 35% of it, came from companies who mined silver. The rest of it was byproduct discovery where companies mining tin or copper or gold or something, I'll say, oh, look, we found some silver. So, yeah, I mean, it's a very small mining industry. I think your point is valid in anything when you're talking about from farming to mining and anything in between where you use lots of energy to move the earth and to accumulate metals or to accumulate a harvest, plant and reap the harvest. You need lots of energy, and as the cost component goes higher, so too does you have to pass that price on, and also it becomes harder and harder, in particular with mining, to especially when you're exploring, you're hoping you find something, you're spending an awful lot of money, increasingly so in terms of energy, to hopefully find those deposits. So yes, there's no question, but that rising energy costs would be one of the biggest factors or deterrents to the mining industry being successful, and in particular finding new deposits or exploring altogether. So yeah, it definitely will be a headwind to the mining industry.
Shifting the focus to the technical aspect, silver exhibits a neutral to downward bias. Analysts predict a potential extension of losses if silver achieves a daily close below the latest cycle low observed on October 26th, marked by a swing low of $22.44. The technical outlook underscores silver's challenges, signaling a cautious stance among investors. Andy further emphasizes that the current lower price of silver, when compared to its historical high, has created a disincentive for exploration in the precious metal sector. This reduced enthusiasm for exploration activities raises concerns about the future supply of silver, potentially leading to a decline in discoveries and impacting overall production. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.